Right now, somewhere in Australia, a family is packing up their rental because their landlord just hiked the rent by $150 a week. In Sydney, a young couple has been saving for 6 years and still isn't even close to a deposit. In Brisbane, a trade professional earning 6 figures is being told they can't afford the mortgage on a standard three-bedroom house. This is the reality of Australia in 2026, and it's clear that something has gone seriously wrong with the housing market. To truly understand the scale of this crisis, we have to look at the numbers. The median house price across Australia's capital cities has now crossed the $1 million mark. In Sydney, that median sits at a staggering $1.62 million. Even cities once considered affordable, like Brisbane and Adelaide, have seen double-digit price surges over just the last 2 years. In total, the national residential property market is now valued at over $12 trillion. To put that in perspective, that value is larger than the GDP of every country on the planet, except the United States and China. So, how did we get here? The first major factor is supply. Australia simply does not build enough homes. Under the National Housing Accord, the federal government set a goal to build 1.2 million new homes between mid-2024 and mid-2029. While that sounds promising, the plan is already a year behind schedule. Independent forecasts suggest the country will fall at least 262,000 homes short of that target. In the first year alone, 60,960 fewer homes were started than what was actually needed. While supply lags, demand is accelerating. Australia's population grew by over 423,000 people in the 12 months leading to September 2025, reaching a total of 27.7 million. Net permanent and long-term arrivals hit a record high of over 480,000. Every single one of these people needs a place to live, yet in 2025, the net increase in housing stock was only about 165,500 homes. The math is simple. Crushing demand is overwhelming a stagnant supply. A detail that often gets missed is that the biggest driver of cost isn't construction, it's the land itself. Land prices have risen more than 500% since the year 2000, while construction costs went up about 150% in that same timeframe. This means that when politicians talk about cutting red tape for builders, they are only addressing a small fraction of the problem. The real bottleneck is the cost of the dirt underneath the house. Layered on top of this are tax policies that tilt the playing field toward investors. Negative gearing allows property investors to deduct rental losses against their taxable income, while the capital gains tax discount cuts the tax on property profits in half if the asset is held for more than a year. Together, these policies make investment property incredibly attractive, often putting investors in direct competition with first home buyers. Investor lending is up over 23% in the last year alone. While the government is examining potential limits to negative gearing, no firm changes have been announced, meaning the system still rewards speculation over homeownership. For those who can't buy, the rental market is equally brutal. The national vacancy rate fell to 1.1% in February 2026. A healthy market usually sits around 3%, so at 1.1%, renters are competing against dozens of other applicants for every single listing. Average monthly rents in major cities are pushing toward $2,600, with tenants spending a record 33% of their income just on rent. This is well above the threshold that experts consider housing stress. Even among low-income renters receiving government assistance, 43% are still in rental stress. The barrier to entry for buyers has become nearly insurmountable for many. The average home loan deposit in 2026 is approximately $173,000. Meanwhile, the average full-time income is about $110,000. To service a mortgage on an average home, a single buyer in Sydney would need to earn roughly $200,000 a year. In Brisbane, that figure is $166,000, and in Melbourne, it's $145,000. These aren't luxury estates, these are standard homes for average people. Consequently, home ownership for Australians aged 25 to 29 has dropped from 50% in 1971 to just 36% today. The human cost of these numbers is staggering. Over 122,000 Australians are currently experiencing homelessness. Up to 3.2 million people are at risk of losing their homes from a single life shock, such as a job loss or an unexpected bill. The proportion of renters stuck in housing stress for 2 or more years has jumped to 60%. Furthermore, over 254,000 households are on social housing waitlists. In New South Wales alone, 67,000 households are waiting for a place to live. These are real people sleeping in cars or couch surfing because they have nowhere else to go. This crisis didn't happen by accident. It is the result of decades of policy choices, zoning restrictions, underinvestment in social housing, tax structures that reward speculation, and a planning system that is painfully slow. If you are navigating this market, it's important to realize that waiting for a crash is rarely a successful strategy. Prices rose nearly 9% in 2025 and are forecast to rise another 5 to 7% in 2026. If you are saving for a home, you have to be strategic. The government expanded the 5% deposit scheme in late 2025, allowing first home buyers to purchase with a much smaller deposit and no lender's mortgage insurance. There are no longer income caps or wait lists for these spots, which could save you years of saving time. You might also consider exploring regional areas where your money goes further. If buying feels impossible right now, focus on your overall financial health, increase your income, reduce your debts, and invest in other assets that grow. This housing crisis is a massive policy failure, but it is also a personal finance challenge. How you respond to it today will shape your financial life for the next 20 years. The more you understand the forces at play, the better you can position yourself to weather the storm. It's time to look past the headlines and understand the reality of the market we are living in. Stay informed, stay strategic, and keep building your financial future.